Cast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. This is Bobby Rains. I'm here for our periodic members-only workshop. Let me get my screen shared here. There we go. All right. So yeah, I'm here for our periodic members-only workshop. We skipped a week last week, but this week is probably more interesting to talk about than Wednesday of last week was. So we got that going for us. All right, let's get to the agenda. Pretty standard agenda. We'll talk about the market, we'll talk about what's going on in InvestorsObserver, and then questions, site demonstrations, and etc. We got a lot, by a lot, I mean significantly more than normal questions ahead of time, so I got a more pre-prepared content than normal, but if you have questions at any point, put them in the question box there. I see Ted's already got one in there. Yeah, we will get to them either at the end or, I usually have two screens open here. So, if you have a question about what I'm talking about right now, I'll try to get to that as opposed to, looping back like that. But, put the questions in whenever, and we will try to answer them in the correct order as much as possible. All right, so let's go to the market update. So here's our 2 years of one-day candles. This is pretty standard chart for this workshop. We hit new highs as recently as last week, and then yeah, it's been less good since then. I drew these lines here mainly for the next chart, just so you could get an idea for context here. We can go through to here now. Well, let's stay here for a minute. Yeah, you can kind of see these lines should have been some support levels based on them being previous all-time highs, and there being some other support really didn't hold up like that. May or may not serve as resistance on the way back up also. And then, yeah, more recently, obviously we had, when you see these big gaps like this, there was a question a couple weeks ago about a gap. And essentially this is a gap, right? And you see them on the upside as well, right? Like there's a gap. You could do it from either the, you consider a gap to be either the top of the candle to the top of the, or to the bottom of the next candle, or, sometimes, including the wicks. Either of those can be a gap. So yeah, these big gap open, or these big gaps at the open have been because a lot of stuff happens when the market's closed. Yeah, global economy and whatnot. People making big announcements and policy changes outside of market hours will cause those gaps to happen. And so yeah, these are the exact same lines from the other things. You can see we just kind of blasted through the most recent previous high, and then took out the high from, I forget when that was, 2018, the early 2018 high. Took that out without much trouble before lunchtime yesterday. Or no, not yesterday. Sorry, Monday. Yeah, so yesterday's candle is circled here, just sort of as a good illustration of a technical analysis piece. Sometimes you'll hear people refer to an inside day. This is pretty much your definitional inside day. You got a big candle, and then the next day's candle, including the wicks, is entirely inside the previous day's candle. That is an inside day. That's part of the reason why we didn't take the opportunity to be like, oh hey, the market's up a couple hundred points, let's put out some portfolio trades. An inside day is not a reversal pattern in either direction. And so, needless to say, we weren't particularly surprised by the open today. I did, if you're paying attention closely here, this candle is red because I took this chart out a little bit earlier this afternoon before things came all the way back. The S&P closed green today, which that's much more encouraging than the inside day yesterday. So we'll see what happens there. but this market is not really technically driven in any real sense. It's much more of a news-driven market, which we'll talk about on the next set of slides. All right, so this is a chart that I had last time. What we didn't have when we did this a couple weeks ago was some of these big moves. I think we were probably, I don't remember exactly where we were. Yeah, somewhere along in here in the middle of July when we did our last workshop. And we talked about the big spread between stocks and bonds because these things tend to come together over time. And yeah, the stock piece has gone down, but the bond piece also went down, so we didn't really do much coming together. And this is since January 1, 2017, but this one is since September 1, 2018. I picked September 1, 2018 because I wanted to get, this was sort of a high before everything sold off in stocks last year, right? So here's that big Christmas Eve decline in stocks. But what you can see here is that, and so the bond piece here, the blue line is yields. So yields move inverse to price. So as people buy bonds, the yield goes down. So this sort of high point here for bonds that we hit last year before the market broke down, and then stocks came back and set new highs, but bonds sort of bottomed out here and have been a pretty steady rally. There's sort of a breakout here, which is interesting in the last 2 days, basically. But yeah, bonds have been pretty much on the same trajectory since, you know, September, early October of last year, which is sort of interesting. That's why a lot of people have been sort of more bearish, even in the face of this this recent rally to new highs than maybe they were previously. Is because, yeah, people look at the bond market a lot of time in terms of future economic expectations, and the bond market's been pretty sort of, I mean, it's been a bull run for bonds, but it's typically sort of bearish in terms of economic growth, and a lot of times it can be bearish for stocks, but it obviously hasn't been in the short term here. All right, what else is going on? Trade still, right? Like there's been a lot of developments. Oh, sorry. There we go. There's been a lot of sort of news since last time, but still I don't really think anybody knows anything. We got new tariffs. We got some news about currency manipulation and China being designated a currency manipulator, which we'll talk about on the next slide. And then, yeah, talks are supposed to resume in September. But given how talks ended the last time and given the things that have happened in the in-between times, I don't really think some sort of overarching trade deal is likely anytime soon. I don't think it's likely before the end of the year, to be honest. I think the best case scenario at this point is probably a continuation of the status quo. You may get some walking back of things, but it seems kind of unlikely. The Fed and interest rates, it seems likely we'll get another cut. We may get 2 cuts this year. The thing that's interesting is the Fed is reacting to the trade situation, which is weakening the economy much more than they're reacting to the the actual health of the U.S. economy. Obviously, the U.S. economy is part of the global economy, so they're kind of trying to get out ahead of things there. The Fed has been criticized in the past for sort of being behind the curve in terms of cutting when things start to go south, so they're, I think, trying to read the tea leaves a little bit there. But in the U.S., the data is softening a little bit, but the economy is still strong overall. Consumer-facing parts of the economy in particular seem to be doing pretty well. And then the last piece, which I expect to start to get more press in the next few weeks here, the EU is, it turns out, pretty uninterested in negotiating a Brexit deal with a different prime minister from the same party than last time. Like, they negotiated a deal. I don't think they feel like they need to negotiate another one. So their position up until now has been, yeah, we're not doing that. And so no deal Brexit starts to look increasingly unlikely at a certain point. So we'll see how that develops. Yeah, so let's get to, so currency manipulation. What does it mean to be designated as a currency manipulator? It's largely symbolic. It says the U.S. must initiate talks. There are literally already talks on the schedule with China for September. So I guess they could have side talks about exchange rates outside of the talks on trade, but it seems pretty clear that China sees those two as of a piece, and I think the U.S. side does as well. They can also take it up with the WTO, but I don't expect the U.S. could take it up with the WTO, but I don't expect that to be particularly fruitful. And the reason for that is this: the U.S. has a couple points that you have to hit in order to be labeled as a currency manipulator. One is a significant bilateral trade surplus, so that means significantly more goods flowing from China to the U.S. than flowing from the U.S. to China, well, goods and services. In any case, that part is true. A current account surplus of greater than 3% of GDP, that means you're exporting more than you're importing in total. That part is not true. China doesn't actually export more than 3% of their GDP compared to what they import. And then persistent one-sided intervention in the currency market. This is interesting. China has been designated a currency manipulator before, back in the 90s, because they spent a long time keeping their currency artificially low. Their economy was growing super fast. They wanted to keep their currency low because it's good for exporters and not so good for importers into China. So yes, they have absolutely been a currency manipulator in the past. More recently, they have let the currency float a little bit, but the more recent big move was actually they supported the currency less than they previously had been, or maybe they were unable to support it. In any case, actual market forces, because China's economy is currently slowing down some, actual market forces were pushing the currency lower, and China didn't step in to prop it up in ways that they have in the past. So, yeah, I have a hard time imagining some sort of third-party arbiter saying that not intervening in your currency is the same as intervening in your currency. Certainly, it's frustrating that the rules keep changing, but this doesn't really feel like anything, any sort of textbook currency manipulation. But yeah, in any case, the whole thing is largely symbolic and is very much part of the broader trade war, trade negotiation picture. All right, so I don't have very many big announcements about what's going on at Investors Observer. We're still working on an extremely large project that I've been teasing for a long time, which should give you some idea of the size of it, but that is all I could say at this juncture. All right, so let's get to the questions. So Robert wanted to know if we had a suggested method when credit spreads end up in the money near expiration to salvage the trade or minimize account drawdown. There's basically three moves here. There is rolling the position, which in a vertical spread functionally ends up being closing a position and opening a new one. If you're going to close a trade, whether it's for a gain or a loss, I feel like after you do that, you should evaluate all your trade options before selecting the new trade, as opposed to saying, oh, well, this is a trade I just closed on this stock. I should do a new trade on the same stock. I understand, yeah, rolling seems like very much like closing a trade and then opening a new trade. There are probably some tax consequences to actually rolling a losing trade and trying to make it a winner that way. But again, it doesn't seem strategy-wise like a particularly good option. Frequently, especially if you're trying to repair a trade, because then what you've done is you open the trade for credit, you close it for loss that was bigger than the credit, and now you're trying to make a new trade that's got a larger credit in order to either offset some of the loss or even offset it entirely plus in order to get you back into the green. A lot of times what you have to do is you have to pay into a roll, or you have to make the spread wider, something like that. All of that is just putting more money at risk on a stock that just moved against you, which has never seemed like a particularly attractive option to me. And so, yeah, our typical strategy here with portfolios is close it outright. It locks in the loss at a fixed point, but you just close it up. You know what your loss is. That is what it is. We try to keep our spreads pretty tight so we don't have a huge loss on any one spread. But that is typically how we do it. Is, what, this thing's going to go bad. Let's close it and go find a better opportunity somewhere else. Another thing you could do, I think that we have considered but haven't done recently in any case, is to sort of leg out. And that is buy back the sold leg and keep the long leg open. What happens there is if the stock continues to move in the direction against you that it has been moving, whether it's a bullish trade or a bearish trade, if it continues to move against you, right, your bought put, if it's a bearish or a bullish trade, right, your bought option will gain value in that case. That could recover the loss. It could lead you to a larger than expected gain, depending on how far the stock moves. The downside of this is it could also lead to a larger than expected loss. And that's because if you close the thing outright, you're buying it, right? You sold an option and bought an option to open. You buy an option and sell an option to close. You have some money offsetting, some money coming in offsetting the money going out. If you only sell the leg, you're now essentially putting a little bit more money in and hoping that long leg will run. So you're not selling it immediately. And so if the stock reverses and goes back in the other direction, now you sold your, right, you close your sold leg and your bought leg is open and now you can't sell it for anything. So that's sort of the downside to legging out. But that feels like probably a better middle strategy. If you're unwilling to just close it outright, you can try legging out. That seems like a better strategy to me than really sort of putting more money, putting more money into something that really went against you. All right. All right, so David had a question about buying puts, both on individual positions and on the portfolio as a whole. So individual positions, particularly ahead of earnings, this is a thing that we've done here. Typically, we do it as part of a collar. So you're selling the call and then using some of the money from the call to buy a put. And yeah, buying a put can protect you against downside. It does raise the cost of ownership of the position. Obviously, if you buy a stock and then buy a put, for you to be profitable on that stock position, which is going to be the biggest dollar piece of that, the stock needs to go up higher because you put more money into the position. But buying a put does cap your downside. At a certain point, the put starts to accumulate value. At a certain point, dollar for dollar for everything you lose on the stock. So that's the reason to do that. You can also do a collar to offset the cost of the put. The other side of that is, though, it does cap your downside, but it also caps your upside, right? So you have basically a covered call and a bought put to go with it. So if the stock goes up super high, you're not going to get all of the upside from that, but your downside is capped and typically at a lower level. So something that you expect to be sort of range bound, something like a collar could be pretty good. Or even if it's just a thing where you have a position that's mildly profitable and you want to see if you can keep it open and you don't expect it to make a big move after earnings, but you kind of want to lock it in there against a loss. If it does, certainly the collar can work there. But typically, though, this is the sort of thing you want to do against a specific event, right? Like if you have long-term concerns about any particular stock that you're holding, I think a better question to ask is, why are you still holding the stock? Right, like that just makes sense to me. And the thing that there is, you want that you want that bought option to be, because you're hedging against a specific event, you want it to be relatively short-term. Again, I mean, because buying long-term insurance on a thing that you're expecting to appreciate in value doesn't make a ton of sense like that. Now, on the portfolio as a whole, right? So something like this week happens. Now you're talking portfolio insurance. There are, yes, it turns out, lower transactional costs to insure a portfolio than to try to insure each position, right? So if you have a broad basket of large cap stocks, you can just buy puts on either the SPX, the index, or you can buy puts on the SPY, which is the ETF. The ETF comes in a little bit smaller units, but it's super liquid. The spreads are pretty tight. That's totally fine. And the reason to do this is, in the same way that they tell you on TV every 10 minutes that bundling your home and auto insurance will save you money. Think about it as buying an insurance policy on every stock you have versus one umbrella policy on your portfolio. It's cheaper because there's fewer commissions. And then, like individual stocks tend to have a little bit wider bid-ask spreads, and you have to navigate a lot fewer of them if you just buy something on an index. And so that's typically what we would say there. And this is the thing where you want it to actually be longer dated as the cost per day gets lower as you go longer. Right? I'm sure everybody's seen what the options price curve looks like. And since you're long, right, this is unlike most of the strategies we do here where you're short time value, you're long time value in any sort of long option. And so you want to go out in time. Now, there's some risk and reward there. Like if you're buying puts on the overall stock market and the stock market goes up over time, the insurance value of that put tends to go down as the stock moves away from the strike price of that. So you don't want to go, you don't want to just go buy a 3-year put at some percentage out of the money from Monday's lows. Because if we go back to new all-time highs, your put's basically worthless if we go back to this level 6 months from now. So there's some time constraint you want to consider there. And you could also roll it as the thing starts to expire. That sort of strategy will be a drag on your portfolio generally. But if you think about it, buying insurance at all is sort of a drag on your, on the returns on the money that you have. But there are good reasons for insurance. So I'm not saying don't buy insurance because it's a drag on your returns. I'm just saying, like, be mindful of how much your insurance you're buying for what kind of drag it is. And the other thing to consider in both of these cases is, one, you don't have to hold an option that you buy to expiration, right? It's a thing you bought. It's just like a stock you bought. You don't have to hold a stock. You hold a stock until the stock gets bought and goes away. You just have to hold the stock until the price goes up and you want to sell it. So you don't have to try to time your expirations to be when the stock will bottom out. Because if the option moves, right, if the stock moves down, the price of the option will go up. And so the other thing to consider here, in addition to trying to buy the right amount of time value in terms of hedging an individual position or portfolio insurance, is we typically sell options here pretty close to the money because that is where the premium is. If you're buying an option, you don't want to buy a lot of premium because premium just goes away every day. And so that means the stock has to move further to overcome your, to move you back into the green there. So you can look either in the money. In the money gets pretty expensive when you're buying puts. It's maybe not the best thing to do in terms of insurance, but if you're buying options generally, calls or puts, you can look a few strikes in the money. It seems silly. It seems maybe like it doesn't make sense to do that. It's a little bit unintuitive to look in the money because you're paying a lot more there than you would be buying one strike out of the money. But some of that is intrinsic value. That won't go away unless the stock goes way down. Or you can look, strikes out of the money. And it doesn't matter what the likelihood of assignment on that option is because you don't have to hold it to expiration. If you buy a put that's a couple, that's way out of the money, and let's say you buy one super far out and you pay like a dime for it. If the stock moves just a little bit and the price of that put you bought for a dime goes to 25 cents, you just made 150% return. And you can sell it then. You don't have to hold it to expiration. And so you kind of want to keep your horizons there, but it does get to be sort of a little bit of, it's long option trading is essentially what it is. Whether you're doing it in terms of insurance or doing it just as a trade, that probably plays in terms of like how much you want to put into the position. But the basic strategy is the same there. So you maybe don't want to go buy a put right at the money. You probably want to look I would say a few strikes out, somewhere, yeah, I mean, at the money is going to be about a 50 delta. And so you probably want to go down to somewhere in the 40 to 25 kind of range, depending on how big a move you think it's going to be. And obviously, the underlying volatility of the stock will affect the Greeks. But if you're expecting a bigger move than the market is, maybe, then maybe you can go with an even lower delta there, because you can, yeah, your return will be a lot higher in exchange for what it is you're paying it. All right, and then we got this question from Kamlesh, who said, can we sell a naked call for a naked put that is likely to be assigned? I love these questions, these sorts of questions where people try to invent an option strategy, because, yeah, this is what I did for weeks when I started getting into option trading, was try to figure out all the answers and solutions, right? It seems like the options market is complex enough that it should be able to break it somehow and win. Turns out it's also a market which makes it kind of unable to break it and win. But I do like these questions where people are really trying to sort of push limits and figure out what the things they can do are. So if you have a Amazon put that you sold in 1925 for 42, can he sell a naked call for 1900, September 19th for 19 premium? Can he sell the call? One of these a put is one of these a call. He made them both calls in his question. But yeah, in any case, can you do this? It turns out that selling a put and a call of different strikes, typically you would sell the put at a lower strike than the current price, and you'd sell the call at a higher strike than the current price, is a short strangle. This seems very much like a short strangle. It may not be that exactly. Certainly, Amazon is at something much lower than 1900 right now, so that makes it a little bit different. But yeah, short strangles are typically a bet that a stock will stay inside that range. So if you have a put that you sold that's lower and a call that you sold that's higher, you're betting the stock will stay inside that range. It can, depending on the size of your credits, it can run outside a little bit, and you can still be profitable, but it is a bet basically that a stock will stay in a range. In this case, obviously, it's a little bit different from a strangle in that your put is already well in the money. So what you're trying to do is sell premium here to recover. The first red flag to me on this is potentially, for the vast majority of traders, this just wouldn't be allowed by a brokerage account at all because you have an uncovered call here, right? So you can sell a put because I can calculate the exact loss for every put that you would want to sell. If you sell a call, the loss is incalculable, right? A stock can only fall to zero. And so the most you can lose is the difference between the strike price and zero. On the call side, there's no real limit to how high a stock can go, and so you have an uncapped potential liability there. So most brokerages won't let most traders just sell a naked call. So what you might try here is a credit spread. And so here what you're going to do is you're going to sell a call, you get some premium, and then you buy one that's even further out of the money that should be even further out for less. And what you might even consider is buying one that's longer dated. And so the net credit will help offset your loss. And then if you buy that longer dated call, if everything expires, you end up with a long call on Amazon, which, I don't know exactly what the shape of this trade is in terms of, where Amazon will be in this, at September expiration when this closes up. But if you sold a September call to try to get some premium back, and then bought a super cheap call in like January or something, now that's a trade your broker will let you do because you don't have an uncapped liability. And also, it's a trade that after this sold put and then sold call deal, if all that expires worthless, now you can, right now you just have a long call on Amazon that hopefully will recover value. The downside to that, I suppose, is Amazon goes way back above your sold call, and now you just lost a bunch of money on that side. But yeah, at that point you're making money on your put. So it gets a little, yeah, without knowing all the specifics here, it's a little hard to exactly structure that. But those are the sorts of things I would look at in terms of trying to figure out how to recover from that sort of situation. And then, yeah, so that is the last question I got ahead of time, but we got a few questions in here. Rick says, lately in the news, 7 yuan to the dollar has been mentioned. How and why is 7 to the dollar determined? 7 is a round number, right? It's not 7.63 or 27 or 6.98. So that's one of the reasons 7 is significant. Now, how is it determined is essentially by a market, right? People are trading you in for dollars, and that sometimes people say I'll give you 7, and sometimes people say I'll give you 7.15. What happened recently, though, is, like I said, China has a policy of only allowing it to move by about 2% in either direction per day. And then Monday night, whenever that was, they either didn't support or were unable to support, because it is a market after all, right? They were unable to actually hold the line there, and it went through 7. There's no real magic about 7 other than it has kind of historically been a floor, at least in recent history. The real news is less the 7 and more the, hey, it made a big move downward all at once, because they sort of failed to support it in the way that they typically have. All right, then we have a question from Ted who says, why don't we include more bearish strategies? I mean, the sort of pat answer to that is because the market spends most of its time going up. I mean, that's the gist of it. I mean, we could try to put in some strategy where we have 1 bearish position open for 3 bullish positions all the time, and we would just expect the 3 bullish positions to win and the bearish position to maybe lose. I mean, ideally all 4 would hit, but stocks are typically pretty well correlated. And so we mix in bearish strategies when we feel like it's appropriate, when there's a strategy we like, a setup that we like, kind of a thing. But yeah, typically bearish strategies typically end up being riskier just because stocks tend to spend more time going up than they do going down. And even stocks, right, like stocks that are really in trouble, right, you look at, say Sears before it declared bankruptcy or something. The last few days there, obviously that's great. But in the, 3 years before it finally declared bankruptcy, they had some real big up days in there, which now you just got to, right, like match your durations and hope a positive news headline doesn't come out. That's a good way to get killed. There's a lot fewer big downside surprises picking solid companies and trying to avoid earnings, which has typically been our strategy, than there are upside surprises picking bad companies and hoping they don't, pivot to blockchain or one of any number of other things that have in the last few years caused stocks to just jump for no reason, but unexpectedly and not something I can see coming on the calendar. All right, more questions. All right, well, if there aren't more questions, our next workshop will be 3 weeks from today, which is August the 28th. We'll send out emails ahead of that per usual. Again, if you have questions anytime, you can give us a call, hit the help button on the website, and we're happy to answer. If it's something that you'd like to see, sort of discussed in a little bit more length, where I have thoughts to get have a chance to get my thoughts together a little bit more, you can certainly send those ahead of time and say, hey, this is a question for the workshop. Yeah, I certainly can come up with interesting things to talk about, but I feel like the best, the best questions to answer are the questions that people actually have, as opposed to making up questions for people to have. And so, yeah, I think it improves the quality of the webinar quite a bit if we get those questions ahead of time. But yeah, we're always happy to help or answer questions, whatever. All right, so I don't see any more questions coming in, so we'll go ahead and sign off here. But thank you all for listening. We'll send out recording, link to the slides sometime tomorrow morning. Yeah, enjoy the rest of your day. Thank you.